You're about to hear my conversation with the CIO of Equities, Leslie Marks. We talk all about the latest in Donald Trump and tariffs, as well as his threats to Chairman Powell. We also talk about Canada, the upcoming election, and what to expect out of Canadian-US trade negotiations going forward. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. I'm your host, Matthew Schnurr, and I'm delighted to be back with Leslie Marks, our CIO of Equities. Leslie, welcome back.
Thank you. Lots to talk about, Matt.
There sure is. But I want to start off with probably the biggest headline of the past week, arguably, I guess, since there's so many. But it's President Trump and his relationship with Fed Chair Powell. Certainly, there was a back and forth on his Truth Social account where he suggested that he was disappointed, and that raised a question if he was preparing to fire Chairman Powell. He did walk back those comments the day after. What's your take on this, and how would you explain the change of heart?
Well, first of all, I would say that this is really just a lot of unnecessary drama that the capital markets just do not need right now. But I think the best place to start on this subject is to start with the issue. Like, what is motivating President Trump to have his stance on Jay Powell, and what is Jay Powell and the Fed's positioning around rates at this point in time, just to give some context.
Sure.
And I think the president really just wants to see lower interest rates because he knows that lower interest rates will help the economy. But it's almost an admission that the tariff policy is going to have a slowing impact on, well, certainly the global economy, but the US economy specifically, which is what he mostly cares about.
Right.
There's also an affordability issue. We've heard the president talk a lot about costs, inflation, the importance of bringing inflation down. He's been extremely critical of the previous administration for the rising costs for basics like eggs, the grocery basket,
Sure.
gas prices. And I think he posted even today on social media that eggs, groceries, and gas prices are down and how great this was. But when it comes to financing big purchases, particularly homes, mortgage rates specifically, there's definitely an interest in getting interest rates down, and it's material when it comes to an individual's basket of expenses. So his motivation is partly the economy, but partly because of his promise to make affordability part of his platform. Now, contrast that to Powell and the Fed's position, which is very much focused on their dual mandate of price stability and maximum sustainable employment. And when you look at the crudest of data on both of those subjects, you've got, our most recent CPI reading at 2.4 for the US and unemployment at 4.1. So the hard data continues to come in kind of supportive of where the Fed is today,
Right.
on the sidelines. And the Fed obviously, has a very difficult job to try and, in addition to looking at hard data, also to look at soft data and to try and anticipate the future. So it's not like they're not considering the tariff impact, but every day, and I'm sure we're going to talk more about it, we're seeing a lot of change around what the tariff impact will be. So this is not making it easy for Jay Powell and the Fed governors to make decisions. They don't know at this point in time what they're dealing with. And a big, nucleus to that uncertainty is coming from the Trump administration. So if they knew that tariffs were going to be a universal tariff of 10% from here on, until someone changes that, then I think they could operate under those conditions and they might make different decisions. But when you see tariffs at the 50% rate and then the next week it's 10% rate, and then you hear that this is a hold for 90 days and the tariffs could come back, it's very hard for them to have the ability to make definitive policy decisions. And so I think that's where we're at, that very much like most CEOs across the US
Sure.
are also in a holding pattern. The Fed is also waiting. And the other reality is it's likely that the tariff policies, even as they are discussed today, will be inflationary. So they're trying to manage that dual mandate of we know directionally inflation is moving higher. But we also know directionally, in the context of the tariffs as they're proposed, probably the US economy is slowing down and they would want to support that. Unemployment increasing, but they don't wanna have the legacy of runaway inflation on their watch either. So there's a lot of competing things happening. It's very easy for the president to try to demand, uh, and lobby, Jay Powell to decrease interest rates, but their job is extremely difficult, right now. The current consensus is still in that 3 to 4 range, for policy moves, this year. That really hasn't shifted in a while. Now I'll come back to sort of the events of, the last few days and the flip-flop.
Sure.
And it's clear that, the president was, looking at ways to potentially remove, the Fed chair, from his role. His own economic advisor, told reporters that they were studying how to remove Powell. He talked about in Truth Social how he could remove him anytime if he wanted to. He, called him too late Powell. He really tried to sort of antagonize, the situation. And then what you were referencing was by Tuesday, we heard he wasn't going to remove him at all. So clearly he had a view, but ended up taking the advice or counsel of some of his advisors. I think it was the Wall Street Journal that reported that they believe that Treasury Secretary Besson and Commerce Secretary Lutnick were the ones that counseled him against the move because the implications were going to be extremely negative. We already saw that when markets opened on Monday with the sell-off, and the upside was really not worth the potential downside that this would create in the face of global perception around US assets, US stocks, US treasuries, as well as the US dollar. So, summary was that he had a view, he wanted to take action, but he thankfully listened to the counsel of his advisors that this would be a terrible idea. So that's where we are today.
Just to follow up on that, how much does the rhetoric constrain future actions of both Powell and Trump? Powell's term's up next year. I believe they have to elect a new Fed chair. It's unlikely that he'd be, I'm sure, extended. Will the markets be looking to see if that individual has an expectation of following Trump's lead? And then also, Powell, in the meantime, if he's cutting interest rates, does it look like he's succumbing to the Trump pressure, or does that enter the calculation? Or how do you think about this over the sort of medium term?
It is a really good question, and it does compromise the view around independence because if at the next meeting he does cut interest rates,
Right.
people will say, well, did he just cater to the pressure of President Trump? And I remember this was actually the case in the fall when they were also looking at cutting interest rates, and the president has accused them of being political at that time to support the Democrats because it was the Fed meeting just before the election.
Right.
So I have confidence that the decisions made are data driven and they are supported by the economic data. But that doesn't mean that there won't be a lot of speculation and conspiracy theorizing
Sure.
around decisions when it comes to the Fed. But I do think that when you look back, obviously with the benefit of hindsight, and you see the Fed's decisions, you can see the clear pattern of objectivity around a data-driven decision, and that is the objective perspective that, this current Fed has, had, and certainly specifically the Fed Chair, Jay Powell.
Great. Why don't we move to trade and the latest on tariffs? Obviously, in the center of the crosshairs on this tariff war has been China. They have had the most significant tariffs put on them, and there's been a lot of rhetoric back and forth between both Chinese and the U.S. Reported in the media, and I'm sure lots not reported as well. We've started to see a bit of a reversal from Trump, suggesting that he's open to a deal and he's open to dealing with them. Why do you think he's changed his tune on China? And or am I misreading what's been published?
I don't know if I'm reading the same things that you are, and most of them are headlines that don't have a lot of substance. But I do think that there is something to be said around sending the message that the Trump administration is willing to de escalate with China. So the question is, why now? Why this way? Was there a catalyst? And when I look across what some of the news events were this week, I would say one of the most important on the China file is the meeting that the president had with the CEOs of Target, Home Depot, and Walmart.
Hmm.
And you can imagine what that conversation would have been like. And I think what it would have focused on is the fact that we're really in a situation right now. If you're importing goods, which all of these companies do, to fill your shelves, and you're having conversations with your suppliers in China, they're basically saying either we're not going to ship, or the recipients, the importers, are saying don't ship because today the tariffs are 145%, but next week they may be 20% or
Right.
50%, and we don't really know. So, who's going to take that economic risk? And the shipper is not taking that risk. So, the risk ends up sitting in the hands of the importers in the United States, which brings us back to this idea that the tariffs end up being a tax and very much a consumption tax. These companies like Target and Walmart, their net margins are in the 3 to 4% range. They cannot afford to take price on these goods. And so the only person who is going to take the price on these goods is going to be you and I and
Sure.
everyone listening to this call, the consumer. So, we're heading into the spring. A $20 lawn chair becomes a $40 lawn chair. So, these are the practical conversations that they're having with President Trump and his advisors. And what they're saying is that the situation we're headed to is higher priced goods on our shelves, but first, empty shelves.
Right.
And who shops at Target, Walmart, and Home Depot? Everybody. But no more. The biggest consumers in those 3 stores are the president's base. And so this is going to have very direct impact on the voting base. And the president understands that. So I think that's why we started to see some indications around a willingness to lower tariffs. But when you read through the headlines, they were talking about moving them from 145 to 50 to 65. I mean, they're just throwaway numbers at this point.
Right.
And 50 to 65 is not going to be an acceptable range to end up at for any of the importers coming, bringing goods in from China. And actually, the one of the most interesting comments that was across the headlines yesterday was Scott Bessent saying, we're not in a sustainable place right now with China, and we're basically in a trade embargo. In other words, nothing is coming in or out. So we need to advance things. And so it's very problematic where we're at right now. And it highlights the need to kind of move the needle and start discussions with China, because really this cannot go on for many months. It's really going to be felt very hard across the US economy. And when I reflect and I think about this, a lot of people are looking at the situation we're in today and trying to draw analogs to previous material market events. And what I've been thinking a lot about is that we're sort of heading into an intersection between what we experienced in COVID, which was significant supply chain disruption, which is, I think, where we're headed if things don't reverse in the next little while. And maybe even, when I say an intersection between that environment and the environment in early 2000 when we had a material
Right.
economic slowdown post the tech boom in the late 90s that peaked in 2000. And I think that's the economic piece. And so we obviously want to try and avoid both of those scenarios here. And I think we can. I think there is an off ramp to do so, but we're a ways off from that. But that's really the catalyst, I think, for the reverse thinking. The last point I'll make is not that the Trump administration cares about what the IMF says, but some people do. And this week they came out and they have global growth revised down 0.8% to 2.8%. And primarily the reason is citing the tariffs, and the US economic outlook revised down from 2.8 to 1.9. Well, we know that the president does not want this on his track record if there's any sort of accuracy to this data. So I think that this just reinforces why we think we will continue to see some reversals in the really tough tariff trade war that we're in right now.
Let's broaden out the discussion when we're talking about the trade war to talk about the rest of the countries, not just China. With the sort of 10% baseline tariffs and reciprocal tariffs and trade agreements with 70 countries that have come forward to the administration. These trade negotiations have historically been very long negotiated trade deals. What do you think gets done in the short term here?
Well, I think when I first heard that we were going to have a 90-day reprieve, my initial thinking was that we actually would see some quick wins. I thought that that would be important for the administration to come forward and say we've had some successes, and that would allow people to really support the initiative and the trade war. I've had a bit of a rethink about this, and part of this comes from I've been watching some of the discussions around the trade deals and some of the speculation that the trade deals are more than just bilateral trade deals. It appears that the administration is trying to bring another dimension to the trade negotiations, which go beyond, you lower your tariffs to zero and we'll lower our tariffs to zero kind of thing. Like that would be the easiest thing.
Sure.
But I think I'm thinking less that that's what it's all about based on what I've been seeing and reading. And for example, today there was a headline from Japan saying that they will push back on any efforts to bring it into an economic bloc aligned against China. And I've heard this from other policy analysts as well, that this could be part of the USMCA renegotiations with Canada and Mexico as well. And so for a country like Japan, China is a bigger trading partner actually than the United States. So they can't
Sure.
afford to alienate that relationship just to benefit their US trading relationship. So I think that it's going to be a lot more difficult for the US to wield the power that it thinks it has in these negotiations. And if I'm on the other side, because there's a recognition that the administration needs some quick wins, I'm probably motivated to take this right towards the end when it comes to the 90 days, which is I think early July. So, I don't know, like as a negotiating tactic, I think that there are certain power moves on both sides of the table, and I think that there might be some smaller country announcements as opposed to what we originally thought would be the big, Japan, EU, South Korea. That we thought those would come early, but I think it's going to be more difficult than what anybody thought. And I would also take it back to the three goals that were communicated on Liberation Day: bringing manufacturing back to the US, reciprocity for existing tariffs and to generate revenue. I want to focus for our listeners a little bit on the revenue generation as well, because that's been a big part of the platform, which is
Yeah, sure.
right? I mean, the president keeps talking about the billions that they're bringing in every day from tariffs. Um, what I don't know is how much of that quote billions was already coming in from previous tariffs from the president's first term and the tariffs that were enacted on China. And so I don't even know incremental revenue, what they're achieving and what they will ultimately achieve. But what I do know is the goal. And the goal was $1 trillion in additional revenue and $1 trillion in cost cutting from government spending in order to balance the budget. And I think we're a long way off. So there's a lot of both of those numbers. So I think there's a lot of contentious things happening around these negotiations that are going to make it difficult to have the conclusion on deals much before the end of the deadline in July.
Great context. Let's turn to Canada. It's been reported and known that negotiations are sort of on hold with the Trump administration until we get through our election, which is coming very quickly. I voted on Good Friday. I waited in line for an hour to cast my ballot, which is the first election that I think I've had to wait that long. It's usually a much more quick process. I wasn't alone, of course. Over 7 million people have already voted. Um, what do you think the outcome of the election would be, and what do you think the market reaction may be?
Okay, well, I don't. Are you asking me to predict the outcome of the election? Well, here's what I will say. A couple of things on that front, but I I went on to the. I was actually coincidentally. I didn't know you were going to ask me that question, but um, went on to the Poly markets this morning
Okay.
because this morning I had heard sort of as my alarm was going off, more information about the polls, but I couldn't dissect what I was hearing. I was just waking up to it. But I think what the essence was that the polling numbers continued to favor the Liberals. And then I saw on the front page of the Globe today speculation around Poiliev not even getting his seat. So I'm going to park that because I feel like that is maybe a bit of fear mongering, but I don't have
Sure.
any specific insight. So I'm going to go with the Poly market, which is basically calling for an 85% chance that the Liberals win. So that's obviously a very high odds. And so I think that's probably a fairly good prediction. They're also calling for the Liberals to get 172 seats, which is technically a majority, but it's right along the line.
Right.
So I think the possibility is it could be a minority, but very close from a seat perspective. So either way, that's where the betting markets are at right now, and that is aligned with the polls. So that looks directionally like where we're going. As far as how the market reacts, I would say, well, probably the market is pricing in a liberal minority government, would be my guess. If it ends up being a liberal majority, I don't know that that really changes anything for the market. So I don't think we get a big reaction. I think the only thing that would be market moving is if we saw a surprise, and right now a surprise would be a conservative win, and
Right.
Pierre Poilievre is our next prime minister. Obviously, that would be in a minority government situation, so the mandate would not be that clear for the things that the next prime minister, if it is a conservative prime minister, wants to do. All this to say, that's a very long way to say, I don't expect any major market reaction from the outcome of the election on Monday night. Obviously, we will be available to talk about
Sure.
that as things play out late into the evening on Monday.
And the parties have recently released their platforms. Do you expect that to change any of your comments while looking through the platforms or sway any voters?
Well, the first thing I will say is, and I'm going to take it back to your comment about 7 million voters voting over Easter weekend,
Right.
because the two platforms were released after that. And I mean, that's a very unfortunate situation. I don't know if that would have changed people's views on how they would vote, but I do think that while there were some similarities across the two platforms, I think the big surprise was on the deficit side, and particularly the Liberals growing the deficit to the extent that they've suggested they would have to. In the case of the Conservatives, the surprise would have been that the plan projections weren't to balance the budget. Having said that, I don't know that anyone would have believed that anyway, because, we are heading into a more challenging time because of the trade war. And again, I'm going to use the overused word of there's a lot of uncertainty around what that looks like and what a renegotiated USMCA looks like, et cetera, et cetera. But I think that the liberals maybe were a little bit more realistic around the impact. I don't know if realistic is the right word. It could just be um, they incorporated a potential slowdown in the Canadian economy because of the trade war. The Conservatives had a more bullish view on that and had less of an impact to the
Right.
Canadian economy. And in fact, they've probably been the most criticized because the assumption is that smaller government, lower taxes would stimulate investment in the Canadian economy and that that would generate GDP growth. And typically that is the case, that does happen, but this is in the face of a difficult time where governments may need to support a lot better. And this really highlights the importance of governments pulling back on fiscal when economies are doing well so that they have dry powder to manage a downturn such as the one we're in right now. And I think that the fiscal spending was too high in when times were good. And I think most people um, that focus on fiscal responsibility would agree with that. So with respect to the platforms, I would say in the interest of time and the fact that we're only a few days out from the election, I won't spend a ton of time, but I would say, the liberal platform is a bigger government platform. It has the government more involved in things like housing. Um, you know, yes, less red tape for um, development, but still a bigger government platform. The Conservatives are calling for much smaller government, less government involvement, more business investment spending to grow the economy. But, those would be sort of philosophical differences that you would
Sure.
expect from a liberal versus a conservative election platform that they would be campaigning on. So, nothing too surprising. Like I said, just I voted last weekend too. Would have been nice for 7 million Canadians to have that information to inform their voting decision before they place their vote.
Fair enough. Whoever wins, the first order of business will be U.S. trade. Clearly, it's the dominant issue in the election. It's the dominant issue that is facing our country. What do you expect to happen on the days after the election? Do you expect that to be not only our top priority, but the U.S. administration's top priority? And what activity do you expect surrounding that?
Well, this has been very interesting. And I think back to your original question of market impact after the election, I think this is a lot more impactful.
Sure.
Um, Especially for those companies that are most leveraged to the Canadian economy, but also for uh, companies that are important exporters, especially to the United States, companies in the auto industry, et cetera. So we've had a bit of a reprieve for the past month, which has been nice because it has allowed Canadians to focus on the election and our candidates and not be as distracted by um, the rhetoric around trade with respect to Canada, 51st state talk, etc. But we're starting to see this creep back into the dialogue again. And the last couple of days, I've seen comments from the president about Canada might be subject to higher than 25% tariffs on automotives. Um, Also, a little bit of talk again about Canada as a state, how Canada can't survive without the United States buying their goods. And I think that this is coming back into President Trump's lexicon because I believe the USMCA negotiations will start very soon after the election. And I think he's starting to troll again to instill fear. And this is part of the classic negotiating tactic today I heard him say that the US doesn't need our cars, that Canada would cease to exist if they stopped buying cars from Canada. Um, this is obviously really a one-person view. The Canada US auto history stretches back over 60 years with the Canada US Auto Pact, and every capital decision since then has been made within the confines of our trade agreements. And so disentangling 60 years of decision making is not going to happen in 12 months, even, let alone, 3 months or 3 weeks or whatnot. So, again, I would just view this as a lot of rhetoric, a lot of trolling. It's positioning ahead of this negotiation, um, and we will wait to see what the next best deal ever is going to look like with the next USMCA. But I think that the automotive industry is very important to both countries. And of course, as most people know, we import more cars from the US than they do from us. And so, yes, on a per capita basis, that impacts us more, but on a number of vehicles basis, we're a very important importer of American vehicles, and the industry recognizes the importance of the two countries working very much together. And that would be the case in many manufacturing industries that fall under the USMCA agreement. So I think we all look forward to this getting put into the rearview mirror, because it is a bit of an overhang that we've enjoyed um, a reprieve from for a little bit, but it will come back to the front pages, I suspect, by Wednesday of next week.
Right. Great context. Maybe my last question is I've grown accustomed to 3% up days and 5% down days, which is something that you typically don't have to grow accustomed to in equity markets. Um, is the worst of the volatility past us? What's your thoughts on that?
Oh, I'm just going to get out my crystal ball for you,
Excellent.
Matt,
That's what I
and
want.
give it a look. No, I think actually think we touched on this. We spoke around this in a way, which is if you think about, well, first of all, when you saw the Liberation Day tariffs, that created the real big spike in volatility. And I think
Right.
that may have put in the peak in volatility for the year. So at least we know what the high watermark is for volatility. So to answer your question, have we seen the worst of volatility pass? If you think that that was the worst, which I think it was, then we probably have seen the worst pass. The second question to that is, okay, we're still in elevated volatility. Volatility is at a rate of about, as measured by the VIX, by about double what the average for the last 12 months had been. Recognizing that it had been extraordinarily low, that doesn't mean that it's not still elevated from these levels. And I think when you reflect on our whole conversation today, a lot of it has been about um, short term decision making, changes in posturing, extreme views, negotiating tactics, unpredictability, uncertainty. All of those things say to me that the expectation is that volatility will be elevated from those very low levels, but we don't expect to see the extremes that we had experienced early in the month, particularly around Liberation Day, because it's just too destructive to the economy. It's too destructive to corporate America. It's too destructive to the president's base. He is listening to his advisors. I think investors should take some comfort in that, if nothing else, that creating an extremely chaotic situation with US Treasuries, for example, will not be to anyone's benefit. So we expect to see a little bit lower volatility than the current elevated levels. But volatility also creates opportunity. And if you are not a day trader, which would be I know volatility can be good for day traders because there's lots of opportunity to make money, but most people don't do that successfully. If you're a long-term investor, like our portfolio managers who really focus on a long-term perspective with the companies, and many of them use DCF modeling to make decisions when it comes to equities, and when they're looking at a more than 5-year time horizon, and sometimes in the case of 10 years, these dislocations create amazing opportunities. And that's what we're really seeing as people are looking at the names that they may not have owned because of the valuations being
Right.
unjustifiable, but now they've had the opportunity in current market environments to buy names that they may not have had the chance to in the past. So it's a very good environment for a long-term investor that can afford a little bit more volatility. The motivation of any president, no matter what, is to leave a legacy of a good economy, which will lead to a strong stock market, stability, low unemployment, low inflation. Even if the president is talking about people taking a little bit of medicine here in the front end to adjust the trade relationships that he has around the world or that America has around the world, there will only be so much patience for destruction of the US economy. And I think we all deep down know that in our heart of hearts. So there will be another side to the valley that we may feel like we are in today, and we shouldn't lose sight of that.
Leslie, why don't we end there? Optimistic note to end on. So thank you for that. And thanks for spending the time.
Well, it was a great conversation, and we talked about a lot of different things today. And I look forward to reconnecting in the next few weeks when we see some resolution on certainly our election. And we will certainly see more related to the Canada US trading relationship.
I look forward to that conversation. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.